knows it is not the last lecture because of blame the grandchildren. Yes, there was a family party, and one of them had a little teeny tiny little sniffle, and both my wife and I got sick and had to cancel the vacation last weekend. So there you go. So the next two lectures are about the complexity of the financial system in and of itself. And this kind of complexity is it is one of the main reasons why there are central banks. And the place to start is to think about what are called financial panics. And that's where we're going to start and having to do with financial bubbles. They're easy to describe. They're certainly far more understandable after they occur. But the whole purpose, the whole reason that banks and the financial system need to be regulated, because if they're not regulated, every so often they blow up, and they blow up in new ways, they blow up in different ways, but there's always one consequence. It has huge consequences of the economy. And what happened? We had a financial panic in 2008 and 2009 and experienced the worst recession on record since World War II. There's been tons written about exactly why we had that financial panic, and I'll be talking about some of those reasons in this course. But the important thing to remember is the following. An awful lot of people think when something hasn't happened for a while, they think it won't happen. And so they say, oh, well, the banks know what's going on, so they don't have to be as regulated as much as they were in the past because, oh, they're so sophisticated. They got financial models. They're very smart people. There's all these PhDs running around with finance, economics, statistics, math, you name it. And lo and behold, almost as soon as they start believing that, it makes the risk of a financial panic higher. And that's one of the lessons you learn about financial panics and disasters. We had one with the savings and loan industry uh, uh, 30 years ago. These things happen. And the question is why and how do you prevent them from happening? Because when they do happen, it's it's bad for everybody else. And the financial industry, typically, for the most part, with a few exceptions, walks away with large bonuses unscathed, and everybody else is experiencing something. So, okay, I'm pressing on the button, guys. It's not changing. Let's let's see if I do that. No. Mm-hmm. I know there's something I'm supposed to do. Let's see. Okay, let's see. Is it working? No, the clicker is not working. Okay. So some terminology, there's terminology as if you've seen throughout this course. We got nothing but definitions and terminology to talk about. So what is a bubble? Okay. Nope, it's frozen. And I know you know the secret sauce, right? Yep. Well, I could do that too if you teach me. Yeah. Okay. So it's trading an asset at a price or price range that strongly exceeds quote unquote intrinsic value. That is such a latent statement as to what is a financial asset's quote unquote intrinsic value. Nevertheless, we can witness things that have happened, and it's a situation in which these prices appear to be occurring on implausible or inconsistent views about the future. And for periods of time, well, the markets believe in that future. It's kind of like when you were in high school and someone's participated in a chain letter and they made some money, and you'll, wow, what a great idea. I got to participate, and you do it, and you never got any money back. And it's by definition, it's a losing game. But there can be some people that win, and it encourages other people to play the game. An economic bubble or asset bubble could be also called, this is one of the things you need to know about finance, which is we use different terms to mean essentially the same thing. So speculative bubble, market bubble, price bubble, financial bubble, a balloon, they all mean the same things. And the phenomena is, as you'll see, is defined by these price changes, which when you look back at them, you go, what were they thinking? You'll see I got a graph for the tulip bubble, and you go, how is that even possible? Okay, so as you'll see, I put together a list. Uh, Bubbles have occurred fairly frequently. They date back to the 1600s. Uh, they are widely regarded as an element of current economic systems, and it is why we have financial regulations. And it can impact any financial. It's not just stocks, bonds. So there've been runs on sovereign bonds, currencies, housing prices, which was underlying the bubble and the financial panic of 2008 and 2009. And it occurs in any economy with financial markets. That means the US, Canada, Europe, Russia, Southeast Asia, you name it. They can all do it. And of course, and this is why I'm starting off this lecture with a little bit about financial bubbles, because really it is financial bubbles that are the reason that we have financial regulation. It is the reason. If you look at the history of this, just Google or Wikipedia Federal Reserve, they'll have a whole series of stuff on when the Federal Reserve was created, why was it created. It followed a financial panic in the United States where it's a famous story. It was bailed out by JP Morgan, and eventually responsible people said, this is not the best idea to have one private rich individual bail out the whole economy. And there was lots of material for them to look to in terms of the creation of a central bank. And that's really the original reason for the creation of the Federal Reserve, was to mitigate financial panics. It wasn't until the 30s that Keynesian economics and suddenly the role of the Federal Reserve changed significantly. So they lead to loss of credit. In fact, that's what a panic is. A panic is suddenly lenders of all kinds suddenly saying, oh, I'm not going to lend any money. We don't know if we don't know if we'll get our money back. I'm not going to lend any money. They just the fear factor is so great, which is exactly what happened in 2008 and 2009. You get what are called bank runs. Silicon Valley Bank is an example of a bank run. Everyone here I'm sure, has seen it's It's a Wonderful Life with Jimmy Stewart. Yes, I'm telling you, the images in that movie are what a bank run was. And sure enough, as soon as Silicon Valley Bank they went, the reporters went down to the various banks in Santa Clara County, and there were people standing in line waiting to try to get their money out. So, but what it's really all about is the true economic cost, which is it leads to recessions and depressions. And sure enough, if you go back through U.S. economic history before we really had good data, this isn't, of course, in macroeconomics, but if you looked at those graphs, you see a great deal of volatility and frequent financial panics. And it's just useful to remember that the Great Recession was the consequence of the busting of the housing price bubble. I mean, we were living in an era of Trump, in part because of what happened that many years ago. And here's just a partial list going back to the 1600s to, Economists have written about this. There have been historical books you can read about the South Sea Bubble, the Panic of 1785, the Panic of there was a financial panic in 1785 during the Revolutionary period, Panic of 1792. Just look at the frequencies and the number of countries have involved. These things happen with great frequency. And then finally, this guy, there's the dot-com bubble that affected the NASDAQ, the stock index, and it can affect, the thing to remember, it can affect almost any kind of financial asset. And the question is, well, if it affects, just one financial asset, that's pretty small, who cares? But look at what happened when it happened to the housing price sector. And the real question is, gee whiz, how'd that happen? And we'll be talking about that. So here is the tulip bubble from the 1600s. You can actually go and get this data. It's a great one because it's unbelievable. I think there was a story in the Chronicle today about free tulips at Union Square or something. They've planted a bunch of tulips. I don't know. But it was just a total disconnect between the fundamental value of something, in this case, the price of a flower, okay? As demand for tulips grew, tulip prices rose, people were making money, you had all kinds of behavior, everyone bidding on it, generating huge increases, and then it collapsed a couple of years later, and within months, tulips were selling for 1% of what they had been. And that's what the graph looks like when you pull the graph off of Wikipedia in terms of how fast it goes up, and when it comes down, how fast it comes down. And the deal is, when you're in this part of the cycle, you go, hey, maybe I can put a little bit of money in here. Maybe I can make some, hey, it's going up. Well, that's not how it really works. Almost by definition, there's going to be more losers in aggregate. Since there's nothing really being produced, there's going to be more losers than there are winners. It's not that there won't be any winners. And that's why I've advised my children to stay away from cryptocurrency. What is cryptocurrency? I've been asked this in class. I've been asked to give a lecture on cryptocurrency. I'm not an expert on the Yes, see, exactly. 33%. And why? Exactly. Exactly. And the reality is cryptocurrency has all these kinds of features associated with it. People made a lot of money. You hear about people making money that gets advertised all the time. The prices are going all over the place, and there's all kinds of stuff. But here's US stock prices in 1923 during the roaring 20s, and then stock prices dropped. There are debates within the academic financial community. Is there such a thing as a bubble? Markets are always efficiently pricing something. And there are real disagreements as to, is this an example of efficient markets, or is this an example of a price bubble? I happen to side with one of the Nobel Prize winners, Robert Shiller from Yale, that it's not hard to say to humans, that's a bubble. Because why? Because the prices went way out of control, and suddenly the market changed. There was a storm. Who knows? Their views changed, and suddenly the prices dropped. This is U.S. stock prices 1986 to 1989 in terms of a bubble that we went through. It went down 26%, and then stock prices returned. And the classic case is, oh, well, is this a bubble or not? And when you're looking at this side of the mountain, the answer is maybe. That's the point. Uncertainty. If you knew, you would have bought here and you would have sold there and would have just waited to here and bought here. And that's where you hear about people making huge gains in terms of trading. They've guessed right. And that is no different than walking into a casino and having somebody play roulette and bid on a number, and the number comes up, they bid on another number, that number comes up, and you think, well, obviously they know something. And you know that they don't know something because we're well trained enough to know a roulette wheel unless the house is playing games. What the odds are supposed to be. This is the this is the Nasdaq. This is the blow up of the dot-com bubble. Books written. It's a new era. Profits don't matter. There were statements like that while the Nasdaq was going up, and it it suddenly turned. And you can go into, well, what were the signals? Why did it turn? What what is the timing of all this stuff? That's the hard, that is in fact the hard, the hard stuff is looking at something like this and knowing it's not going on to go on forever. And if you're a good trader, you know the point is there. If you're me, your point is there. And that's the reality. That is the reality of, in part, what this course is really about. if if you're not the person that can call this, stay away from it, because the markets are going up and down like this, going up and down like this all the time. This is the Japanese Nikkei 1984 to 2002. It has led to, in fact, what is referred to the lost decade. Wasn't there some period of time there were movies about Japan taking over everything, the stock markets, that everybody was getting rich? It's not true. They've been in a very weak economy for decades. And in part, it's because of the resolution of how they've dealt with the bubble coming through stocks and real estate. Krugman's referred to them as bubbles. Here's one way to look at it: is you just collect the data that's out there from the world economic agencies. You just look at GDP per capita per person, and you say, it was growing like this right up to 1992, right until the movie with Sean Connery came out about the rising sun and the powers of the Japanese culture taking over the economy and all that stuff. It blew up, and look at the difference in terms of the improvement of social welfare on average in Japan since then. It has consequences to go through a bubble in terms of how various economies adjust. This is housing. This is housing prices in the United States. It's a classic bubble. There's movies, books. Well, we'll be talking about some of the influences as to why did this happen. And the answer, believe it or not, there's all kinds of details and exactly how it played out, but there's really only one answer. Where were the regulators? What were the regulators doing, and what were the regulators not doing, such that this particular bubble and the Big Short, the Big Short is in part, they've got scenes in there about lending money to people with no money down, lying about it, nobody cared, all that stuff. Yeah, that's one of the things the regulators are supposed to do. Yes. Yeah. 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 And yes, yes, that absolutely true. Greenspan, he was really thrown off because why? He was believing in the sophistication of the people involved in what's called risk management, which is the area that I specialize in the on risk management, knowing what they were knowing this could never happen because we have all these tools and oversight and principles, and it was happening exactly that way. Yes. No. Uh, Stop. They were not in the dark. No. It's always about it. You could say, you can say, we didn't know it was going to lead to the Great Recession. What you can say is, we could have done something, but nobody would have believed it, that it would have led, and that we've just prevented the Great Recession. And this is the phenomena that happened during the summer preceding the bankruptcy of Lehman Brothers. as we will be talking about, which is they got intimidated by the politics that, we got to let the market speak. They got to learn their lesson because, it only took them a day to realize it was a huge mistake. But the point is, if they had bailed out Lehman Brothers, would anybody have known that the financial panic would have followed? You know, this is why they lightened up Dodd-Frank regulations a couple of years ago because, well, these banks the size of Silicon Valley Bank, they're not going to have any problem. So why do we impose all these extra regulations on them? And the answer is, well, because because they do have problems. So just some ideas about what are some of the things bandied about. Hyman Minsky is the name of the economist who studied a lot of this. And one of them is called the greater fool theory. And the bubbles, financial bubbles are driven by the behavior of perennial optimistic market participants who think cryptocurrency, it went up 36% last year. So are you still in it? Yeah. Yeah. Did you sell out? Yeah. Yeah. If you're going to be rich, you got to sell. Okay. And bubbles continue as long as you can find greater fools to pay up for the overvalued asset. It's a very loose idea. It's a very loose idea, and it's really quite a lot about human behavior and how markets, which are a core element of advanced economic systems. There's markets, all kinds of markets everywhere. And for financial assets, which can trade in very liquid markets, it's a very big deal. You can get a great deal of overvaluation in those markets. And the real question is why and what do regulators do about it? You'll see there's quite a lot of power and ways to intervene. And then the bubbles will end when, okay, there's no more fools out there, and suddenly the price stops going up, and suddenly everyone just goes, "Oh my God, I was wrong," and they get out and start bailing, and then they start selling, leading to significant price declines. So that's one theory. The other one I like more is about herd behavior, thinking about humans as herds. Yeah, it's a little pejorative to be talking about, but it is this idea that, in fact, you know, we're not all that efficient regarding how we think about the pricing of financial assets and where they're going to go. We're not reading all of this stuff in terms of the underlying. And, you know, the trend is your friend. You get into something and everybody else thinks it's great. And what's wrong with that? And the price goes up. And the hard part is understanding, yeah, but the herd eventually stops stampeding. And if you haven't gotten out, the price, if it's significantly overvalued, is going to go through an adjustment. And it's learning by doing, and people get burned. And if enough of them get burned, you're suddenly sitting in a situation of financial panic. That's when there's enough burned individuals that it interferes with the dynamics of the financial system itself. People stop lending. When you stop lending, there's so much lending going on in this economy constantly. Are you kidding me? That's what the banks do. They lend money to all kinds of individuals and organizations. They're lending money, they're lending cash to you. There's all kinds of ways that they're affecting the outcomes of the economy through lending. And then suddenly they just said, well, we're not going to lend because we don't know if we're going to get paid back, period. The economy will freeze. It absolutely will freeze, and it did. And it did freeze in the fall of 2008. And what you find is in this world of herd behavior, if you're dealing with people that have the less experience they have, the more likely they are to follow the herd without the overall fundamentals. And that's why the focus of a lot of what I've talked about in terms of personal investing is really what are the fundamentals? What do the fundamentals really tell you about what's going on in these financial markets? And constantly reminding that I don't know anything about short-term trading. I finally gave up on it about 20 years ago, realizing, well, the PhD is worth a lot, but not that much. There's the Minsky and the 5 stages of a bubble. It's called displacement. All of this is just anecdotal. It's very hard to model these things. And the reason is because all of these different financial bubbles are different markets, different marketplaces. There are similarities, but there are also significant differences depending on the time, depending on the decade or the century in which they occur, the country they occur, because there are different laws affecting all these things. And you just have to remember that that's what makes them so uncertain. But there is this boom, there is this cycle that people go through, the boom bust cycle, in terms of prices start rising and then they really start rising a lot. And we witness that. And then there's euphoria. Hey, look at how much money I made. Oh, I'm much richer than I was. And that is followed by profit taking. Suddenly, some investors start taking profits, and that starts to shrink the market. And then the fifth one is panic, which is suddenly the recognition that, oh my God, I better get out of this. And how quickly you get out of it depends on it. It will determine how much you've made or how much you've lost. As, for example, I mean, it's the famous story during the meltdown in terms of Lehman Brothers. Lehman Brothers very quickly went to AIG, and AIG was way bigger. They were an insurance, they're a huge insurance company insuring all kinds of things. They could not let AIG go bankrupt. And they knew it. By then, it was so clear to those trained that it was over in a matter of a few days that they realized that they'd made a major error. No, their argument in books that the triumvirate of Bernanke, Geithner, and Paulson they've all written books, they've all given interviews, and they've all said the same thing. And they're holding the line on the question. It's quote unquote, we had no choice. You know, that's politics. Did they? There'll be books written on and studies on that. What could they have done? What should they have done? Of course. And the real issues, are the possibility of potentially huge gains and losses in the issues, and recognizing, just accepting the facts. They are not predictable. People think they're predictable, but they're not. When you look at the roulette wheel, it's, at least theoretically, it's not supposed to be predictable. And sure enough, all kinds of people have gone in and tried to understand particularly roulette wheels that may have biases, et cetera, et cetera. But they're not predictable. Not every increase in an asset's value is a bubble. Is Amazon stock now, in a bubble phase? The prices of these things continue to go up. When a market is in a bubble, how do you know it's in a bubble? And if you are in a bubble, how do you know when it will burst? And the answer is, we don't know any of those. And many investors in speculative markets buy late and sell late, which result in significant underperformance of the overall market losses. That's right. Yeah, that's what trading is all about. So I ask you the next question. This is the Fed funds rate. Is it a bubble? It looks like a bubble. Why isn't it a bubble? Because it's not. But yes, I mean, there's a marketplace among banks buying and selling Fed funds, or there used to be. But the real point is the Fed funds rate is determined by a government agency in terms of what the government agency is doing day to day. This is a function of macroeconomic policy, and they're pursuing the goals of macroeconomic policy, which are hard enough for sure. So just because that particular rate has that particular feature, it doesn't necessarily mean that it's a bubble, and that's why I put it up there, because it's governed by completely different principles. You cannot, you nor me, we cannot buy or lend to the Fed funds market. And here's the Fed funds effective rate. This I just continued to do it. You know, this is a result of macroeconomic policy by the FOMC, as we discussed in the lecture of on the Federal Reserve and what it's attempting to do. And it's a really useful example. Not every graph series that looks like this necessarily means it's a financial bubble. Okay, and then this is the famous housing price indices that are put up there. So the real question is, gee whiz, this is the 07-08 housing price bubble. This is through halfway through 2023. And one of the questions is, are we in another bubble? Or is there something else going around that's forcing up, that is supporting and generating higher housing prices in the San Francisco Bay Area and in the US, which we can talk about. So the takeaways, the short-term movements in financial assets are not predictable. It was the first lecture. It's the third lecture. And it's my own bias. There are those who've taken this course who said, well, that may be true for you, but it's not true for me. And I'm, you know, I lived on it, and it's quite possible. It's useful to remember that this is true in the vast majority of financial assets of a variety of forms, and whether we're in a stock market bubble at any point is not knowable until after the bubble bursts. There's no question about, if you go back to this period in time and start thinking about what kind of conversations were you having with friends who were doing this. I actually had a friend who decided he was going to quit his job and become a day trader. And I said to him, don't do it. And he didn't. That's the only time that he listened to me. He was my college roommate. Okay. So this leads to the whole point of the last two lectures is talking about the system, the financial system in and of itself and its complexity. And it's the part that frequently doesn't really get discussed. So I'm going to walk you through some of the elements that make it extraordinarily complex. And there's just things about it inherent in terms of how it operates, in particular because of borrowing and lending, and differences in information sets between borrowers and lenders that you'll see. First, just some data in the financial system so you can just see just exactly how large it is, what its role is, what the information challenges are. That sounds very subtle. It is the information challenges in the financial system that in fact make it unstable. They're inherent information challenges. Believe it or not, Janet Yellen's husband got the Nobel Prize in economics for a paper called The Market for Lemons. Now, that was not about fruit. What that was about was used car market and the differences in the information sets between buyers and sellers of used cars, that the owner of the used car knew much more about that car than the buyer of the used car in terms of, and so there's, you know, the whole idea of efficient capitalist systems is you've got lots of buyers and sellers and everybody has the same information as to what's going on. And the purpose of the paper was to show that the general conclusions about the efficiency of the entire system really start to break down as soon as you really realize that buyers and sellers have significantly and important different information sets. And if you go to any of the car lots, that's about the used car certification program. They have certified this used car is act. You don't have to look at the used car. We've looked at the used car. We checked it out. It's going to be okay. Are those certifications any good? My daughter bought a used Toyota, and that was 10 years ago, and it's still driving. So it worked in that case. But does it work in all cases? And the answer is, well, that's an example of differences in information. They know what they've done. Do you know what they've done in terms of really looked under the hood of the car to do all the various tests? The answer is it's really, unless you're a mechanic, it's really not possible. So this information challenges are central to the financial system. They're central to understanding why we have financial panics, and they're central to understanding why then we need regulations because of these challenges, and that leads to government regulation and supervision and the textbook view on financial panics. And we recently had, it's just a beautiful example. It really is a beautiful example. The management of Silicon Valley Bank mismanages the bank. The regulators don't step in early enough, and First Republic Bank goes out of business. How is that? Well, we're going to find out. So here's a little diagram that talks about why this whole system is, you just start looking at all kinds of elements to it that make it analytically difficult. First is you got complex products constantly. This is the supermarket feature of financial assets and their evolution over time. Even during my lifetime, there's all kinds of things. Hybrid loans, there used to be ARM loans, there's still ARM loans, fixed rate mortgages. Leverage is a core component of the system. What is leverage? Well, you want to buy a house. Well, you can't afford to buy the house with just cash. You got to borrow money. That's leverage. That's what leverage is. You need to borrow money to complete whatever transaction you're talking about. Is there such a thing as too much leverage? As you'll see, absolutely. Then there's this thing called tail risk. What is tail risk? Well, when we start drawing uncertainty in the probabilities of various outcomes, it's very easy to draw what is called the normal curve. It looks like the bell-shaped curve. That has nothing to do with financial lending. The curves that describe what happens in finance actually, they know with some expectations, a small proportion of borrowers are not going to pay them back, and it's priced to account for that, and they do all kinds of things for that. But certain things can happen, and suddenly a whole bunch of borrowers don't pay them back, and it's out in the tail. It's a small probability of a very large outcome. Well, it's exactly what happened in September of 2008. Small probability of a very large outcome, which then led to everybody saying, well, I got news for you. If they let Lehman Brothers go bankrupt, anything can happen. So we're not going to lend money. They didn't lend. GE wasn't involved in an issue, and the famous story: GE suddenly couldn't issue commercial paper. There's asymmetric information, which we talked about. There's perverse incentives which anger the public beyond belief. The classic is the purchase of an asset by a trader on a trading floor. The value of the asset has gone way up. The trader makes the money. They get the big bonus, and the year later, the value of the asset collapses. Do you get the money back? Just ask whether or not we, as consumers of PG&E electricity, have gotten the money back from the bonuses paid to the CEOs and senior management of PG&E, and the answer is no. So there are perverse incentives, and you'll find throughout the economy there's perverse incentives all over the place. You've got asset price bubbles playing through in complex products. All of these things, all of these pieces, they all work together, and they're all built into, believe it or not, the banking system and the financial system. And the general view, without getting into the details, if you want to know what the conclusion is, if you do not control the system, it will blow up more frequently than you know. And we've now experienced one in our lifetimes, and twice. What, what are you thinking is was the financial panic? There's difference. There's price bubbles breaking, but not every price bubble breaking leads to a financial panic. So if you're thinking of the dot-com bust, there's a good question, which is, so how come the dot-com bust didn't lead to a financial panic, but the housing price bubble did? And we'll be talking about that too. So financial systems, they regularly melt down. And just look at what's occurred in the United States. I mean, this is history. These, written at 1797, 1819, 1837, 1857, 1873, 1907, 1932, and then not until 2008. Okay, so here's another diagram. Thinking about, we talked about in the first lecture, risk and return. And that it's part of personal finance. You've got to get rewarded for risk. That concept, that idea, and the way financial markets work is at the core of the entire financial market. It's the basis for it. It's the personal finance and the the financials of companies and participants in these markets is no different. It's all about capital, risk, and return. And there's this other piece, which is, okay, how much should you borrow to invest? Well, probably most of you are not borrowing money to invest in the stock market, but if you go back to the roaring 20s, you were allowed to borrow a lot of money to invest in the stock market. Now it's since then been limited to 50%, but gee whiz, Lehman Brothers, their leverage ratio was 33-1. How did that come about? What happened there? And the next part of the world is, well, we got a lot of financial institutions. We got a lot of financial institutions. We got financial institutions of different types. Fair enough. And they're participating in the market. And then you have these guys called the rating agencies. Well, what's the rating agency? The rating agency is analogous to the used car dealer putting certification on the car, which is they are paid to rate bonds because the complexity of evaluating what is the risk that you won't get paid back, it's extraordinarily complicated to evaluate that risk. And all kinds of entities, personal, household companies, are, in fact, Microsoft has a Microsoft has a bond portfolio. They all have bond portfolios, and they're all relying on the rating agencies. They have policies in their corporate books that say we will not buy anything that doesn't have a rating of at least a AAA or a AA. There's a whole world associated with it, and they played a key role in this, and it's described in The Big Short. They were manipulated by the investment banks. Yeah. Yes. Yes. The issuers. What they're paid by their issuers, and that was one of the things that was pulled out of the Dodd-Frank bill, was to change that relationship so that they weren't being paid by the issuer, because it leads to some complex incentives. And then finally, it's always good to remember this guy. Congress is overseeing the whole thing, and Congress is, through its passage of laws and its oversight of the regulators, is the key element in the system. There's no question about it. And politics absolutely dominates things. How well the public understands these things. There's a lot of back and forth. Yes. No, it's both. It's the entire. I mean, the way it generally works is Congress passes laws, and then the regulators, they can't possibly pass a law that's going to cover everything. In fact, there's a Supreme Court case now up for grabs over this particular question regarding how much leeway do regulators have? It's called the Chevron decision. How much leeway do they have in interpreting what the law is and how you apply it? Because the law was passed 10 years ago. Things have changed. And okay, yes, well, is carbon a carbon subject to the Clean Air Act, for example? Uh, that was rejected by the Supreme Court in a recent EPA case. So how all these things play out, I mean, let's face it, democracies are complicated. Financial markets are complicated. You got a lot of interests, a lot of very powerful interests playing out in financial markets. And in some ways, it's amazing that it works as well as it does. And it's useful to remember that, particularly given what we're going into this year. So what is the purpose of the system? Why does it exist? Why is there a system? Well, first, it's the allocation of capital or funding, cash, for purposes of investment. That is a core element of every economic system. How much do we save? The one question is, how much do we save? And then, okay, and what do we invest? What do we put it into? That's the personal decision. But you want a system overall, the whole economy, that through the interactions of the various members in this system are quote unquote good at allocating capital. There's all kinds of stuff that gets allocated and it doesn't work, especially in the public sector. But that's what its primary role. It's to take savings from households and businesses, profits, governments, etc., and invest those sums into worthy ventures that will improve over time the lives and the lifestyles of future generations. Nothing wrong with that. What's the other purpose? Diversification of risk, right? This is the power of the market economy. The power of the capitalist economy is you've got all these different players out there and making decisions about, well, is this a good idea or is this a bad idea? And, compare that to a government bureaucracy making decisions about whether this is a good idea or a bad idea. How's it working out so far? Sometimes the government actually makes the right decision, but we live in a state where the government doesn't always make the right decision and spends a lot of money doing it. And if you have any doubts about it, just go down to Bakersfield and take a look at California high-speed rail. It is the definition of a boondoggle, which is it will not do what they say. They will spend a lot of money trying to do it, and there's a major question whether or not they'll ever finish it. They're years behind. They have spent billions and billions more than they promised. And what are the politics? Gavin Newsom just awarded them $4 billion. And where did that money come from? The cap trade funding system, which is to put pollutants in the air, you have to buy a permit. The permit goes to the California Air Resources Board. The California Air Resources Board is doling out billions of dollars a year to various projects. Yeah, that was okay. It is the intermediary between individuals, households, and businesses, the intermediary between those who are saving funds and those who are investing funds. How does all that work? Whatever it is, it's important. It's important that they get it right. And organizational structures, it's good. It's a good thing that they're efficient at it. I mean, they aren't terribly efficient at it. I've worked in Bank of America and Citibank, and I can tell you there's a lot of reasons to suspect how efficient they are. But you're living in a system where there's an awful lot of stuff from the internet revolution that has made your life in terms of financial transactions a lot less time consuming than it used to be. And you know, how much cash do you need? How effective it, all that stuff is all part of what we experience as individuals. And this is why I started here. This is their job, prevention of financial panics. They did not do their job in the fall of 2008. And that is why they are responsible, because this is part of their job. So once again, just the diagram, just think about this complexity and its proclivity to blow up every so often. And that's why we have regulations. So we're going to go through some of these things in terms of the various intermediaries and the channels of funds, just so you get an idea of just how large it is and how many roles. You've got the Fromm people. The Fromm people are the savers, households. They're savers. They're saving money. Businesses. Okay, they make profits. They're you know what they do with them really matters. Government with surplus funds. You know, it would be nice if they all had surplus, but that some of them do. And these are largely within banks. These are known as bank liabilities. A checking account is a borrowing of cash from you. It is on in the liability, which the bank then invests, depending on how much they pay out in interest on the deposit and how much it costs them to manage the deposit, which is plenty costly given the payment system in the United States. Okay, they're investing it. They're in different businesses, lending and so forth. That's how they make money. And there's a variety of liabilities, amazingly constant across the United States. Why is that? Every bank's got checking, savings, money market, CDs, and now accounts. And they haven't gone. They haven't gone away. This happens to be an area of my expertise, but it's just amazing how similarly priced all of these liabilities are over time from one institution to another institution. And they're taking those funds and they're giving it to households. Households are borrowers. Businesses, they're borrowers. Businesses, if you look into a bank checking account that's held by a commercial entity, they have all kinds of needs. They got all kinds of needs flowing through those entities in terms of how they operate. And they have cash flows paid by customers. They have expenses. Huge sums of money are flowing through that system. Okay. And when they're borrowing the money and using the money, they're paying for that, right? Those are bank assets, loans and leases. And, you know, they've got on the other side the liabilities of the households, making up what is called the bank's balance sheet. Well, so the whole purpose is to take money from one source and direct it to where it's needed. And you'll find that all of these things are complex, and we've created all kinds of different kinds of financial systems. An insurance company, for example, is doing something similar. It is taking money from you and businesses. Okay, that's the premium you're paying. It is investing that money and making a return on it. Okay, and then it's paying out money when certain events that they have insured arise. And if those events happen too much, maybe they pull out of that business, such as what is happening in California with various fire insurances you've heard about. So it turns out all of these different kinds of financial companies, they're all complicated. They all have to manage financial risks. That's what they do. Why? Well, the premium, the nature of the premium in an insurance company doesn't react to the world events the way its payouts do, the way global warming has led to increases in fires in California and things like these things are very different. If they want to stay in business, they gotta manage this stuff. And if they don't manage it, what do they get to do? They get to declare bankruptcy. And what does happen when these financial institutions you've got a lot of potential creditors, such as you, who have paid premium for fire insurance, are suddenly left holding the bag. So it's important. They're all regulated. They're all regulated to a different degree. So one of the diagrams you can pull out of the textbooks, and then we'll take the break. Is if you look at it, is you just think about the funding of what is happening in the system, and there's just an awful lot of stuff that is occurring, what is called indirect finance. Funds going directly into financial markets, the buying of stocks, the buying of bonds and things like that. This is a direct thing. They have brokers to set up. That's what Schwab is all about. That's direct finance, but an awful lot of the flow is actually going through the banking system and through other different funds, as you've seen, and then going into the financial markets. And that's why it's called indirect. But it's always from savers to investors. That's the whole purpose of all of these complex organizations. It's all going from one thing to another, and in the middle of it is potentially the management of risk. That's why you have house insurance. Well, why do you buy house insurance? For whatever price you evaluate the house insurance, seems like a good deal in case you have a fire or some unknown event. Okay, that's a good place to stop. We'll come back at a couple minutes after 2. Have I lost you? See, where are we here? 37. Okay. So direct finance borrow funds directly from savers or selling or issuing financial instruments or securities, which include bonds and equities. There's real estate investing and things like that. This is direct finance. There's no surprise. There's all kinds of ways to think about that. That was personal finance was largely focused on, in fact, on the direct finance. We're largely, because we're talking about the system and the institutions in that system, we're going to be focusing on indirect finance, but it's useful to set it up. And financial markets include exchanges, investment banks, what are called over-the-counter markets. It wasn't until I was working at a bank that I understood what an over-the-counter market means. An over-the-counter market means a buyer and a seller talking on the phone over the counter. Not all derivatives are traded in over-the-counter markets, and it's useful. Swaps and a lot of the stuff that came up in the Big Short and during the meltdown in terms of the nature of derivatives. Derivatives are not inherently risky. They were created because they're an efficient financial transaction to manage financial risks. But it doesn't mean they can't be used for speculation, and in fact have been used for speculation, and it can get out of hand even at well-managed firms. Most securities purchased by banks are through investment banks. This is why investment banks and the separation between investment banks. What makes it an investment bank is it is not a depository. It's not a depository institution. And something that we learned about in terms of Lehman Brothers was not a depository institution. It could not raise cash, and it went bankrupt. Citibank, as a huge depository institution, was probably insolvent. Okay. And it got bailed out in the sense of a huge capital investment by the US government to preserve Citibank. Why? Because it was too complicated. That by December of 2008, they had learned that there was no reason not to invest the capital to preserve it, and its stock price has been suffering ever since. Prices may be posted, but usually on screens requiring phone calls, contracts, agreements. So you're not buying stock directly, you're buying stock indirectly. You're going through a broker, you're going through Schwab, you're going online, Ameritrade, and one of those things. But that's what comes under direct finance. Intermediaries are all there for indirect finance, and you're borrowing indirectly. It's called, this is what, when they say financial intermediation, this is what that terminology is all about. And financial intermediaries, just look at the list: banks, insurance company, pension funds, finance companies, mutual funds, hedge funds. And there's some additional in terms of what's on the list. The Federal Reserve has a quarterly report on the financial accounts of the United States, which I will be using, and you can see what the financial assets of all of these different entities look like over time. And that's why I do it, because it's a part to recognize it's not just banks, it's not just investment, it's not just Lehman Brothers, it's all of them. And if you look at what makes something a bank versus what makes something an insurance company, well, it's really about what business are they in, what kind of liabilities are they raising, what kind of risks are they managing, what are the services they're promising, what kind of assets each holds. And the Federal Reserve is not regulating insurance companies. They're typically regulated at the state level, at which means they can vary. So if you look at indirect finance, you just start creating a table and you say, where are they getting their funds? What are they doing with their funds? So banks, we've talked about; insurance companies, premiums, capital, borrowing, investment revenues. Pension funds, it's all based on contributions and the investment returns. You look at CalPERS in terms of what is it doing? Well, it's getting contributions from the cities. It's getting investment. I'm missing a T. Investment returns. This happens. There's nothing I can do about it. I've used this table for how long, and this is the first time I've noticed the lack of a T. In any case, you look at hedge funds. Hedge funds, just remember what a hedge fund really is, but it was created under the Hedge Act by Congress. And in fact, hedge funds are gambling funds. And how much are they gambling? How are they managing financial risk? Can vary from one hedge fund to the other. You hear about various kinds of hedge funds. You should just know, maybe they're hedging something, maybe they're not hedging something. Hedge comes from the law that created them, not from, in fact, what they are doing. And it turns out just one of those misleading terms is sitting out there going, there's nothing hedged about this term. Mutual funds, mutual fund is basically an entity which is investing on your behalf. You buy into the mutual funds. There are a variety of different structures of the equity bonds, investment returns. How do they make money? They charge you for the services. They charge you for how they sometimes take a share. One of the advertisements is it Fisher has this advertisement. Oh, we don't charge you for stuff. We when you make money, we make money. Whoa. What that means is your stock went up 10% and they're taking 2% out of the top. That's how they're making money. It's very, very misleading. And then there's all kinds of financial firms that issue stock and borrowings, so on and so forth. And what are they doing? Uses of funds. Well, got loans, leases, and securities, investments, insurance payouts, pension benefits. Hedge funds almost can do almost anything that they want. A friend of mine was running a hedge fund, and I asked him, does this piece of paper actually say you can only do this? He goes, that's what it says, but that's not what it means. In essence, because of that, the regulatory oversight in terms of hedge funds, et cetera, how they work. So they get in all kinds of investments of all kinds of. The Big Short was about a hedge fund and about guys who were investing in securities, shorting the securities market, saying based on what they were seeing, the price of securities should be declining, and they were shorting that market, and they weren't declining. And then they made their billions in September 2000, made their billions in September 2007. Mutual funds, there's all kinds of mutual funds. You can look them up at what they specialize: growth funds, health funds, international funds of all kinds. It's totally diversified. And as I said, I'm not a financial advisor, so I don't have to go through the various returns of value funds and growth funds in terms of how they've performed over time, et cetera, et cetera. And I won't. And this is the trillions of dollars in today's dollars regarding how these things have grown over time. And one of the reasons they've grown over time is because the wealth of households has grown over time. There is savings out there and it's getting deployed into a lot of different vehicles. And you look at this and you say, here's the Federal Reserve, here's money market funds, pension funds are very important, banks, mutual funds, GSCs, which is Freddie, Fannie, Federal Home Loan Banks, and some agricultural specialized lenders. And it's very useful to track what was going on. This bubble here, guess where? That's September 2008. They, the financial panic hit. It went across the board and lowered the net wealth of virtually all the economic agents, and it returned. And then that's the panic. That's the COVID panic playing through the investment system in a report just put out quarterly by the Federal Reserve. If you look at it as a percentage of GDP rather than just dollars, this is real dollars adjusted for inflation. If you look at it as a percentage of GDP, you get the same basic picture. But you go all the way. I go all the way back to 1953. Just look at what was there. And I mean, banks have been there forever. Banks and pension funds have been there forever. So these institutions have been with us for a very long time and will continue to be with us in terms of their roles and responsibilities because of why? Because the humans, the economic agents in the system, find them useful and interact with them in terms of business. An insurance company, you interact with an insurance company, you interact with a bank, et cetera, et cetera. And this is part of the overall economic system, and it is growing and will continue to grow. Then we look at assets rather than doing it on a cumulative basis. We look at them to say, okay, what's really going on here? Remember the Federal Reserve guy, okay, where I showed you how much it grown. It was just the Federal Reserve, $8 trillion. This is the beginning of quantitative easing. This is the panic, and now they're very slowly trying to take it. But look at the size of some of these other institutions in terms of these guys. This all has to do with the GSE of Freddie and Fannie and the bailout. Remember, just in case you're not sure, it's important to remember this. The U.S. government took over Freddie and Fannie in the summer of 2008. Guess who owns them now? The U.S. government. The idea was that, of course, they would only own it for an interim period. And one of the reasons they can't get rid of it is because housing is good. We like housing, and they cannot figure out how to create a private entity that would take over what Freddie and Fannie do in the mortgage market and address what is called tail risk, which is one of the bubbles on the diagram of complexity. That no private entity has enough capital to insure itself against an unforeseen event that they know if it goes through the economy would wipe them out. And so as a consequence, because we don't want to therefore raise mortgage rates needlessly by having it a private entity, the U.S. Treasury continues to operate Freddie and Fannie, and they are making money at it, which is pissing off the Republicans. Okay, you look at how insurance has grown. It makes sense. It's grown like the economy. You look at mutual funds here, well, it's largely correlated with stock market indices, and that's why you get the big swings. Uh, you get the you get the banks. What happened? What happened here? Why did banks suddenly grow? And the answer is because of the government bailout of households and the banking system. Where did the money flow? It went into the banking. It went into the banking. It went into checking accounts. All kinds of accounts went in through that system. They wanted the money out there fast, and these institutions are set up to actually receive that money and deploy it. And sure enough, they did. And then finally, you're looking at pensions. The pensions includes both 401k and defined benefit pension systems. One of the reasons I talk about pensions is the dynamics of how defined pensions have worked, and it's coming to a city and county of yours by definition in terms of what's going on. The pension systems they're not terribly good at managing the risk, and the only way they can manage the risk is to slowly move things out and raise the contributions by local governments. And local governments have increased their contributions to the pension systems to try to improve the books of the pensions for their workforce. And that means they can't put it in a park. And so they're going to the taxpayer and saying, we want a park. In fact, the additional taxes help bail out the pension system. It's a known problem. If you look at how these financial trends work, again, it's important to realize real GDP really matters, what the overall inflation rate really matters, and you look at how these financial assets are, how is it that they're growing? They're growing faster than GDP, and the answer is because of that equation I once described to you about the difference between value and earnings. GDP is a flow. It's measuring how much is produced over a period of time. Stocks are a value of future flows converted to a single number through discounting, as I showed you. And so these, in real terms, tend to grow much more worth, including this one. If you look at employment and you look at employment in the finance industry, this is the one I wanted to show you. The employment in the finance industry is growing about twice as fast as total employment. And the reason is the finance industry is growing faster than the economy. They're providing services that households and businesses are demanding, and it takes employees to provide those services. So it's always useful to remember the number one principle of what really determines improvements in lifestyles on average over time. I state it in all of these courses because people don't understand the importance of technological change. Technological change is the reason that our lives have improved over our lives. Okay? Stop, break for lunch. You come back and you say, does that improve everybody's life? And the answer is no. There is no guarantee. And you can come up with all kinds of anecdotes regarding this. But this is I get asked now by friends, well, isn't AI going to lead to unemployment? And I've said, I don't know how exactly it's going to be improving our lives over the next 25 years, but it is going to be improving our lives and my children's lives and my grandchildren's lives, et cetera, because it's got all of the features of the kinds of stuff that we don't understand. Will some people lose their jobs because of AI? Absolutely, but not in total. And it drives the other conclusion that I always like to state for all of these courses: the importance of education. Everything points to the importance of education in a world of higher and higher technology, because the workers who are educated can adapt to the changes in technology. Whereas the guy driving the cart down the street to sell ice to households. That's a person, you know, they lost their jobs when electricity and freezers came into play. There's all kinds of anecdotes of these things. There are distributional effects playing through the system. We can't avoid, and it leads to all kinds of politics. So, efficient financial systems. Think of it in terms of in economics, motherhood and apple pie. Okay, you know, empirical evidence shows strong relationships between financial development and deepening economic growth. But the question is, what caused what? It turns out as economies become more advanced, they become more financially sophisticated. Now, did the financial sophistication lead to them becoming more advanced? And the answer is they really are commingled and correlated. They go together. They're, they're, they are part of the overall systems and the advanced. And just look at what we've experienced in our own lives in terms of, well, the internet revolution wasn't a part of the financial system, but the internet revolution changed the experience of individuals in the financial system regarding what they do, what they look at, all kinds of things. And some of them are in ways that we're not so happy about, and that's hacking, right? Hopefully all of you who have any kind of financial information on your computers, you've got double verification throughout. No, it's not just the password anymore. The cell phone provides the double verification, and so far, up to now, it is the gold standard. AI may break that gold standard eventually. There's no question about it. So you look at the research and the financial developments in terms of reduction in poverty and all the rest of the stuff. Okay. Economic growth per capita is absolutely critical to addressing poverty and lack of affluence. There's no question about it. But it doesn't guarantee that we're particularly efficient at addressing poverty and lack of affluence. And all you have to do is look at the economic growth on average in the United States, average growth per household, all the stuff, anything you want to measure, you can see over the last 40 years, it's improved quite a bit on average. But you look at the statistics in terms of number of families that are in poverty, the size of homelessness, and these other things, it does not solve the distribution issue, but it is a necessary component to solve it because you can't solve it without the growth. There's no question about it. And increases in private credit lead to more efficient allocation of credit, which that's a good thing. An increase in investment in more productive assets and faster economic growth. And in general, the research in the research in this area is I've got to be careful in terms of how I say this. The research on economic growth shows there are two factors that are really influence of advanced economies, and it's the creation of private property and the enforcement of laws to allow private property and having a good legal system and having an efficient financial system that can fund these things as they occur. Can you prove it? And the answer is no. It's very difficult. You can tell stories, but it's very difficult to prove anything because the differences between one country and another country over decades, the cultures are significantly different. And if these things really mattered that much, you would see much higher average growth rates in some countries and not others. And then you could go investigate. Why does this country have a much higher growth rate per capita than this other country? And the only country that has made it is China in terms of up until the COVID crisis. That's why what's happening in China now is a really big deal economically. Okay, inherent issues. We got a few minutes. We'll just get started in this, and then we'll complete out the course talking about what each of these means. Asymmetric information. I love the word asymmetric. What does it mean? There are differences. Lenders and borrowers. No question about it. You know, you got to fill out a form. You got to give them this information. They don't know everything about you. They couldn't provide enough forms for you to fill out in terms of when you want to borrow money from them. We have the same problem between investors in company and managers in company. It's a classic. It's called the principal agent problem. Who, you know, who's, you know, gee, you own stock in a particular country. How a company, how much say do you really have? You, gee whiz, they're representing you, okay, but they're the one they're managing it. Well, within financial institutions, you have this problem between managers and traders. That's right. One kid took down a bank called the Barings Bank that was in Southeast Asia with just a series of trades. One trader. So if you look on trading floors, they have all kinds of infrastructure overseeing this because the managers don't, these guys are very highly paid, but the managers don't want these guys to blow up the place. Regulators and bankers. I live in the world of what's called regulatory compliance. How good are the regulators in terms of getting the information? Well, I work with banks too. I can tell you the banks know a lot more about what's going on inside that bank than the regulators do, as you'll see when we talk about Silicon Valley Bank. The underlying need in the economy for leverage, credit is critical to a capitalist economy. People need funds for all kinds of stuff. It involves risk versus safety, management of low probability events. I mean, you know, we can come up contagion and systemic failure. The Silicon Valley Bank, one of the reasons we're going to walk through in the last lecture, Silicon Valley Bank, is because of this word. It's such a good one. Contagion. It is the basis for deposit insurance and regulation. It is. First Republic is doing fine. They weren't having any problems. Silicon Valley mismanages the place, and First Republic goes down. Why is that? That's what contagion is. that is it's a wonderful life. It is exactly what it is. And overriding, unfortunately, there's no way around it, politics and ideology in terms of there's just so much stuff you hear in the media now, depending on what it is you're looking at or reading, or there's just so much misinformation regarding how this thing really works and why. Because there's ideology. There's just a whole bunch of people that just think, well, regulation is bad. We don't want the government involved. They're just going to make they're just going to make things worse. That's so. It's not always true. So, looking at inverse adverse things, we have different kinds of differences in information streams when we have names for them. One is called adverse selection, one is called moral hazard, and the other one is called principal agent asymmetries, and we're going to be talking about each one. The one that you've probably heard a lot about is moral hazard, but the one that if you've ever purchased insurance, you know what adverse selection is, but you may not have known that's what it is, which is you have auto insurance. Does it have a deductible? Yes. Yes, it has a deductible. Why? Because of adverse selection. Absolutely. And of course, moral hazard. Moral hazard, if you watch the movie Too Big to Fail, this is what Paulson was worried about. Moral hazard was banks thinking that, in fact, the government's always going to if they're misbehaving, the government's going to bail them out, and therefore they're going to misbehave more because the government will always bail them out. That's known as the moral hazard problem. the principal agent in symmetries were like the prior list. Okay, I think this is the appropriate, yeah, this is the appropriate starting point. We'll go through the rest of this stuff in the last lecture. Look forward to seeing you all. Don't forget, it's I don't know what they're doing here on that Wednesday. We may be the only ones here. Pardon? Yeah, yeah. I asked Derek whether it was okay to just extend the class a week. He said yes, absolutely. So